In this video, we're going to take a deep dive into price action. I will show you exactly why price is king. We're also going to do trend analysis. I show you how to find the best trades step by step, how to manage them. We're going to take a look at pattern trading and many other things. So let's first examine how we can find the best trend trades. And the best trend trades obviously are found very early on in a trend, because then you have the most potential that you're catching a new trend and you can ride your trade hopefully for the longest amount of time. And when we look at this chart, there are a few things coming together. First of all, we can see that here seems to be a completed Elliott wave sequence. So depending on how we want to count it, we have completed 5 waves. Here you can see we come from a downtrend. We started trading above the moving average. I'll come back to which moving averages I'm using in a moment. But you see this is the initial trend wave 1 into the new uptrend. We have the first consolidation back into the moving average and to the weekly pivot point. I will show you how to set the weekly pivot up in a moment. Then we have our next impulsive wave. Impulsive wave 3 is usually the largest one. This is the first one where we are just rolling over from a downtrend into a new trend. Wave 3 is then where we have the biggest participation. Here it gets a little bit tricky. Where do we exactly have our correction wave? But I think we can say that here in somewhere we have the correction wave, and then we have a very weak impulsive wave here, wave 5, which is usually the case. Wave 5 is often, not always, but often the weakest one, as the trend that has been going on is maturing. Probably a lot of traders who were participating before are taking profits, and that is contributing to the slowing down of the market. I'm using here 2 moving averages for this video, the 100 and the 50 period SMA. Nothing fancy, but I think they work really nice. And what we can see now is that for the first time in this uptrend, we are seeing that the 2 moving averages cross. Of course, that's not enough to say, okay, we are now in a downtrend. We have a lot of other factors. For example, here we can see that we are trading into the round number, big round number 1,800. So a very big confluence factor. You can see the previous downtrend ended here at 1,700, and then we had this $100 rally here. So it makes sense to look for some type of relief here. Probably a lot of people are thinking about profit taking at those round numbers as well. Another thing that we can see is that we are in a long-term distribution pattern. So whereas previously you had those waves going up and down, here the correction wave was a little bit deeper. But regardless, we never had a period where the market traded sideways for such a long time. And if this happens, especially in the right context, which we seem to have here, with a completed trend wave count here, with a round number, and then we have the distribution, this is often a sign that the market has a higher tendency to reverse and start trading into the opposite direction. Of course, this is not enough yet to just get short, but it's a first starting point. And a lot of things are pointing here towards the likelihood for the bearish market to increase. You can see we can really nicely define here the distribution phase. Then the market broke out of it. Very strong selling sequence that we have seen here. We are retesting it here, 784, and we are here below the moving average and also below the pivot. Here I'm using the weekly pivot. You just go to indicators in TradingView and then you just type in pivot, and then it's called pivot point standard. Once you go to the settings, then you just change the pivot time frame. I set it to weekly. I'm only using the P, which is the central pivot. I turned off the rest, and then you have the weekly pivot. And what you see is that the first time during this uptrend, we are really actively trading here below the central pivot point. Whereas previously it has acted as support. Here during wave 3, we didn't even come close to the pivot for retesting it. Here you can see wave 1 retested very nicely with a correction wave. But now for the first time, the market is trading below it. Another bearish signal. So a lot of bearish signals are coming together here. And what you could be doing if you want to be an aggressive trader, you trade the initial break and retest out of the distribution phase. And that could be a very aggressive entry. You could probably have a stop loss that should be somewhere around probably the central pivot point, the moving average cluster. If we get back into this pattern and if we would hit a stop loss that is placed here, I would be probably quite glad to be out, since this is quite a deep push, and I would wait then for a new opportunity. So that could be your first idea. Another idea would be, and that's why we're using the moving average and the pivot, is to look for pullbacks back into the pivot zone or the moving average zone. What you can often see is that the market is pulling away from the moving average in a trending market and then coming back to this moving average and pivot cluster. And this is a very common pattern. You will see it here, trend wave, move back into the moving average, continuation. So that could be also something that we could wait for. But let's just see what the market is doing. We are now seeming to push back into the previous support, which is now becoming resistance level. So this looks good. We're using the forward button here on the replay function in TradingView. You can see we seem to be establishing a sideways range with a potential breakout. So the next trend wave could be started here. We haven't pulled back into the moving average, but one thing is really interesting to see is that the moving averages are separating now, which is a very bearish signal. So if you have been trading short from the breakout or the break and retest, or maybe even here, that is a good sign. You can see I'm just fast forwarding. We push back into the moving average, so this seems to be our first pullback that is happening. You can see since we have had quite a strong bearish phase, we are trading below the pivot, which is a good sign. So this is our pullback area. If you are a trend trader or if you want to develop a pullback approach, then those two moving averages work really well. I would recommend using them like a corridor and look for moves into the moving average zone if you want to look for pullbacks. Seems like we are pulling away after the pullback. So now we are in a trending market. We anticipated correctly that we rolled over for now. Let's see what we are doing now. More selling. You can see we hit the moving average once again. Zooming out, you can see. And if, by the way, you have missed your first opportunity, if you have missed the break and retest, if you have missed the second breakout, if you've missed the pullback, what I would be doing now is just wait for another pullback and another correction phase. We are now moving very strongly, and at some point I would estimate and expect the market to have some type of pullback phase. Also very soon we want to get a new pivot point. That's also quite important always. But for now you can see we are correctly anticipating the pullback. You can see now we have a very great pivot structure here. So the pivot has reset, and because the market has moved lower so strongly, the pivot is now coming closer. The pivot is also right at the moving average zone. So if we get a pullback, this would be the perfect place to look for a correction. Let's see. We're still moving lower, unchanged. So good news for the trend traders who caught it very early on. And you could see we are pushing into the pivot moving average for now. Now we are moving into the corridor. You can see probably we have a lot of profit taking. You always have to think about what has happened before, and if there's a strong trend, then also the first correction wave is probably going to be a little bit stronger, since a lot of traders are sitting on unrealized profits, and we could see now profit taking. So we're breaking out of the range, but as long as the pivot is holding, I would not change my mind and still remain overall bearish and look for bearish continuations. Let's see. We get a little bit of a pullback, not very strong reaction yet. We make a double top here. Another triple top. But you can see we are still trading here higher highs and higher lows short term. Moving higher. We're reaching the pivot. Let's just clear this up. So we're reaching the pivot, and we seem to have a very, very precise pivot reaction for now. The moving average has also crossed a little bit into the bullish side, but again, this would be the deciding factor for me. As long as we're trading below the pivot, that would just signal for me quite a strong pullback, but not a change in bullish bearish direction. Seems we have some agreement here, some level that we can probably draw something like that. Okay, seems like we have here our highest high in the pivot, and if this stays a lower high, this would be quite a bearish signal. So what you could be doing is then wait for the breakout. If we resume, you could have your pending order or wait for a break and retest. Both things could be possible here. You can see we are almost breaking out. If you have a pending order, you'll probably be in. Now you can see we have a full breakout now. Now we are trading below the level, so this could be your short as well. If you're trading short, I would recommend stop loss should be above the last swing high. Not too close, not at the high. Highs often get tested, but put it a little bit above it, 70-60. You can see pretty decent level that we have here. We're pulling away. So if you have missed it, or if you don't trade breakouts for whatever reason, wait for the retest in this area. They're very common. So somewhere in here I would expect, if there's a retest, not always will we get a retest, but somewhere in this area I would expect a retest. That's why we never put our stop loss right at the previous high or never at the breakout level. It's just too vulnerable. But if you put it up here, you should be generally, on average speaking, quite safe. You can see we have seemingly a retest. So if you are looking for a retest, this would be your sign and your signal. The 50 moving average is starting to point downwards. Here you can see the 100 is flat and the 50 is starting to go lower. We have a break and retest here with a lower bounce. Great bearish pattern here overall. So more short seems to be quite likely at this point. You can see the next candle, we had a pretty deep retest, and that's exactly what I was referring to. Retests are often going back inside the level, fishing for the stops. If you watch my previous videos, this would be called stop hunting or liquidity trading. We are fishing for the stops of the traders who took the breakout probably here or here and then have their stop loss around the break even level. That's exactly why we don't do that and why we give our trade some room and the stop loss as well. And now let's see, the moving average is pointing down again. The pivot, the new pivot, you can see is still bearish, well below the last pivot. We're seeing good momentum, and now what is happening? Pullback into the pivot once again. Also, where are we pulling back? Into the previous low, becoming resistance potentially. We don't know yet, but looking good. You can see the 50 is back below the 100 period moving average, more bearish signals. You can see we are trading now almost back into the previous low. Bearish overall, I would say, very strong bearish phase. Retesting of the pivot is always a bearish signal. If you are trading this short and if you see that the market is retesting pivots, that's always a good sign. This could give you a lot of confidence in your trade. As long as pivots hold and are retested, that's quite a bearish signal. Again, you can see how this works. Retesting previous structures on the way down. So the moving averages are still very bearish. No pullback yet. We're reaching into the moving average. Now we are almost reaching the higher moving average as well. Let's see, will they hold? For now, yes. Pivot is coming down very close to the price action. See, do we get something here that we can work with? And we're breaking above the pivot. The moving averages have not crossed yet, but they're about to cross. This could be another bearish signal. So here, or this could be a bullish signal actually, and here you can see we're trading above the pivot. So this seems to be now quite changing the direction, whereas here we retested the pivot and here we retested the pivot. Now we are actively breaking above it. And also, in which wave are we? Let's try to see, but let's clear this first up. So we could say this was our first trend wave, second. Now is this a third trend wave? We could say maybe 4 and then 5. You can see in this case the trend wave 3 was quite weak, not as strong as wave 1, but here it gets a little bit tricky. We could also say this is our whole trend wave. So counting waves is more an art than a science and not super precise. So that's what we're working with. So it seems like we don't have a fully confirmed 5 trend wave count here or sequence. So now what I will be looking for, if I would still be holding my short here, trading above the central pivot point is definitely a signal to go out here. If your target would not have been hit, then this could definitely be an exit signal. And for reversals, or if you want to trade new trends, this is actually something that looks really good already. A test of the central pivot point, maybe a retest of the moving averages. So some break and retest pattern around here would be what I was looking for. Another very interesting pattern often occurs at major support and resistance levels. You could build a whole strategy just around trading reactions at those major resistance levels. Find the most important levels. So when we zoom out, you can see this is a really important one. We have here resistance, turns into support, and now we are here at this level again. So let's see what we are seeing right now. The market was in a downtrend here. You can see we traded lower into the moving average, quite volatile, but still a trend is a trend. Then we seem to have found some support at this big level. And now what we are seeing is that we have a short-term resistance level here, just underneath the weekly pivot point. You can see from this low to this low, we started making kind of higher lows, not really convincing yet, but it's a first starting point. And now what I would be looking for as we are trading into this big level, we are looking for reactions away from it. A lot of traders, you can be sure, are looking at this level We had a very strong reaction the last time. This is also a good sign that there is still a lot of buying interest at this level, and that's why it makes sense to look for opportunities. What we could be doing is wait for the market to get above this area. We always want to trade with the central pivot point. That is a good filter tool to have, so break and retests are often what we can look for. But let's see, can we get above it first? And how is the market looking like? So now we're still, the moving average have crossed, but we are in a range market now. You can see they're very flat on top of each other. Now we have a breakout. That breakout is probably not tradable. If you get in here, your stop loss should be somewhere in here, and this is ruining your reward to risk ratio. So sometimes you will get those big breakouts, they're not tradable, but what I would be waiting for is a retest back into the zone. If we get the retest, we can get into a long trade much closer to the pivot, and then our stop loss down here would still give us a good reward to risk ratio. So the market is moving lower. What you could be doing is, since we have a lot of momentum and volatility here, is that we could jump to a lower time frame. We could go to the 5-minute time frame. Let's clear those moving averages. Here's the pivot point, and here is the level that we've drawn here, the previous resistance level. So we want to see some reaction either here or here. We don't trade the levels blindly, so I'm not just going to put a pending order at those areas. That's not reliable enough. I want to see that something is happening. I want to see some bullishness come into the market here at those areas. Let's see what we have. Trading higher first. And now you can see a huge reaction. This looks like it could be news driven. It doesn't really matter what the driver here is. Still, what we're going to do now is probably not optimal, but we have to work with what we get. The price action on the charts rarely looks like in our textbook patterns. So what we could be doing is our entry could be here, and then the stop loss, I would not put the stop loss now down here. We have to be a little bit more aggressive. We have a low here. So what we could be doing is, if you want to get into a long market order, then put your stop loss underneath here, this area. You could put it underneath the cluster, and then looking at this chart, a 2-to-1 would still look quite reasonable here, I think. So what we have here is a 2-to-1, and that could still work out. I think we have a lot of momentum here in this market. The 2-to-1 would put us, I'm always looking left, where is the target going to be chart wise, looking left, and you can see it's right at the previous area. It's good that the target, the 2-to-1, would fall underneath the top. I would not be comfortable trading above the top because those often react as strong support and resistance areas. In this case, it could be a strong resistance. But seems like getting away with the 2-to-1 underneath the previous resistance looks quite fine. Let's see what we have here. The market is moving higher, and we are seemingly in a good bullish trend. Let's see, zoom in, and you can see we're moving higher and higher. Here's our previous high, or this is where our target would be, underneath the previous high. Seeing some struggle here of the price action, doesn't look super bullish, but after the strong trend, it's nothing too worry yet. See, I'm speeding this up a little bit. Okay, we hit the previous high, and I'm going back to the higher time frame just because it's easier on trading view. So here's our target. The previous high is a little bit higher, so let's see what would have happened. Would we have get it, or is the market turning around? And you can see the market turned around, so we got our 2-to-1. And this is a good lesson. If you put your target too aggressively at previous highs and lows, a lot of traders will watching those. And also underneath those areas, if you've watched my supply and demand areas, there's often a supply and demand area just underneath the area, because you can see when we zoom in, there's a huge trend. So you can expect some supply area probably in here. And then you can see how the market is reacting to it, and you'll be glad that you're out. So bigger targets are not always better in trading. I mentioned this many times. Go for what is safe, and you can see sometimes the market doesn't offer you an optimal scenario. It doesn't give you a perfect situation, but we have to work with what the market is giving us. We can change the market. You could, of course, always also choose to skip the trade, but you can see in this case we can be a little bit more aggressive. Not always will an aggressive entry work out, but sometimes it does. So make sure that your reward to risk ratio is set large enough, so that if you get rewarded and if you find a winning trade, the winners can take care of the losses. Here I have a great lesson and some tips for trend trading, re-entry trading, and pullback trading, and some trend tips in general. So what we have here is a trending market on the left. The market was in a strong uptrend, and the uptrend seems to have run into some issues. Right here when we zoom in, you can see First of all, the last leg, if you put an RSI or a stochastic or a MACD, this area here will give you a divergence. Why is that so? Because of the trend wave ratio. Previously, what led up to this point, we had a very strong trending phase, but then the next trending phase that led into this area here was very weak. Just comparing the trending waves here, you will see that this is already here showing you a lot of weakness. So the shorter the trend waves, the weaker a market is. And then we have the double top and the failed breakout attempt. This gives us a lot of bearish pressure here. So at this point, I would not look for bullish continuations, but I would look for breakouts here below the downside. I would not be super comfortable trading the breakout to the downside, because here is the weekly central pivot point, which acts as strong support and resistance. You can see whenever the market is moving into it, not always, but very often you will see a reaction. So what I would be looking for, if you get in short, I would probably play it a little bit safer with a smaller position size, and then look for maybe a break and retest, some signal around this area at the weekly pivot. But let's see what happens. First, we need to get out. Never trade inside a pattern. Always make sure that you are clearing the pattern, and then you are starting a new impulsive wave. As long as you're inside a pattern, you are inside a corrective wave or a distribution or an accumulation. But as soon as you get out, that's where you move over into a trending market as you clear lows and highs. See, the market is now breaking out. So this could be your very aggressive short entry. Stop loss, you don't want to put your stop loss right at the level. I made a lot of videos about retests and liquidity runs. They happen very close to the levels. So your stop loss should be a little bit higher, not too close. Don't be too aggressive with your stop loss. A lot of traders are suffocating their stops. So you can see we're arriving at the pivot. This will be really interesting. If you have not taken the first entry, then let's see what we have around here. For now, nothing really too interesting. We're getting below the pivot, which is great. Let's see what we have. Nothing too major yet. We're moving lower. Let's speed this up a little bit. Seems like we found some support and resistance. You can see how we previously acted or used this as very short-term support, and now the market is at this again. If we now turn around and this becomes resistance, that would be a really great sign. And it seems like the bearishness is coming back to the market. I'm waiting for some momentum. Yeah, you can see this looks quite good. So this looks like now you could jump on this short. We have found here resistance. We are in this overall downtrend. The pivot is holding now as resistance, which is a very, very bearish signal. I want to add a fib, and let's see what we have. So the fib should be applied to the last trending leg. Some traders will apply differently from the high to the low. In TradingView, when you open the Fibonacci settings, you have the option to reverse it. That's probably how a lot of traders are using it. I just use it that way. It doesn't make a difference, and I will show you exactly why it doesn't matter. And what you want to do is with fibs is to really understand trending legs, and you want to get an understanding of trend waves. So let me show you why we are using fibs and what they actually tell us. It doesn't matter how you apply them, it's what they tell you. So in a Fibonacci, what you have is you apply it from the high to the low or from the low to the high, and this gives you this 100% trend wave. So from here to here, this is what our Fibonacci now defines as 100%. And what this means is that this, whatever length this is, we can check it in TradingView with the measurement tool. So we just drag it from here to here, and then you can see it gives us 0.11941. This means from here to here, 100% in the Fibonacci correspond to 0.119. We round it up to 0.12. What is the half of 0.12? It's 0.06. And this is what we should get here at the Fibonacci. You can see 0.059, we round it up, 0.06. And if we go down to 200, this should give us the same as what we have here. So you can see this is 0.1184. If we round it up, it's 0.12. So you can see this leg here corresponds and is the same size as this one. And it's half of this one. And half of it is this area here. And this is the only thing that Fibonacci tells you. Also, obviously the same holds true for the retracement. So this would be half of this one because this is 50. And this is what we are using Fibonacci's for, to get an idea of how long trending waves are, and then we can use the length and project it into the future. So how are we going to use that? We know that this area is 100%, it's 0.119, and this means that there was a very big imbalance in the market and we had more sellers than buyers, and the imbalance was so large that it led the market to sell off that long. So what we do now is to work with that in the future, because we would estimate, okay, because there are more sellers than buyers, we can estimate that there is a high likelihood that we will see a similar reaction. It doesn't have to be the same reaction, but we want to have it similar. That's why in Fibonacci's or with Fibonacci's, we are often using the 161.8 retracement. This means that the area, the distance from 100 to 161 is obviously 61.8% of the initial trend wave. And that's all we want to do, is we want to find what is the trend likely to move going forward. Is it likely that the market is going to go on for much more than what we have done here initially, and we're going to see a huge trend? Of course, sometimes it could happen, but is it likely on average? No, it's way more likely on average. If we want to play it safe, we go for the 161. On average, we will get a high win rate, a high hit rate, because the imbalance here, the seller surplus, is a specific amount, and then this will lead very likely to a continuation that is maybe not as large as what we have seen here, but it could be close to it. And also what we do is, obviously we have here the retracement. We are not starting from 100, but we are starting from here, the end point of the correction wave, which is here at 61. Obviously this is not 61. 61 is here from here to here. So this would be 100 minus 61, 39, plus 61. So for the math geeks, you've probably figured it out. This is also 100. I can show you if we would put it from here, from the 61 right at the level to the 161, and then you can see we compare it, it's exactly the same size. This is how Fibonacci works, and this is what they do. They help us understand trend wave length. And you can see going forward, what are we doing? Are we reaching 161? Yes, we're reaching 161 for now. Let me speed it up to see what has happened afterwards. You can see after 161 we go sideways for a long time. Do we continue eventually? Yes. However, you can see it took quite a long time from 161 to the 200, and you'll probably be glad that you didn't have to hold through all of this sideways phase, experience this little bit of a push against you. So this is how we use Fibonacci's. We use Fibonacci's to estimate the distance between trend waves and to understand what is likely to happen next based on what we have seen on our charts just in the most recent history. Here's a trend trading tip that is helping me quite a lot. So we are here seemingly in a downtrend. The market made lower highs, and now the market has been pausing here for quite a while. A lot of traders will get worried. A lot of traders will be scared out of the market. However, as long as the market hasn't changed the structure, which means as long as the market is not putting in a higher high, then I would still remain overall bearish. As long as we see overall zooming out that the market is making lower highs, I would remain cautiously bearish. And as long as the market is trading in ranges and not breaking structures, like here in this case, and changing the short-term trend dynamic, I would remain overall bearish. And then what I would be doing is wait and look for breakouts and retests. You can see we have a very strong selling candle here, long strong selling sequence. So that's a very good sign. We're breaking out to the downside, which is a bearish signal. And this is a confirmation that we are overall continuing the downtrend. Now what you could be doing is wait for the retest. Again, not always will you get a retest, but if you are not a breakout trader, then that's your only option. See? As long as we are not really falling back deep inside the range, that's good. We're also not blindly trading the level, so you want to see something like that. You want to see that the market is showing you some reaction at the level. You don't trade the level blindly. You also don't trade short as long as the market is moving higher. But now you can see we have an engulfing candle here. This is a bearish signal, and at that point it makes a lot more sense to go short. Stop loss should probably be somewhere here. Don't put it right at this level. There seems to be quite some momentum and volatility, but putting it somewhere above this area, give it some room. You can see we're in a downtrend. If we catch the next downtrending wave, then we have a lot of room. We don't need to suffocate our trade. We don't need to be too greedy with our stop loss, so we can put it down here, and then you can see 2 to 1 would be easily achievable. We could also get a Fibonacci, so you can see we have the 50 retracement, and then we want to make sure we are out before the 161. So the 161 target is here, So we have the retracement here at 50, and then the extension would be at 161. This would give us a 2.5 reward to risk ratio, which in a trending market seems to be quite reasonable. Let's see, we're moving lower, moving lower. The trend is continued. Let's just speed it up. We have some back and forth, and market is now reaching the target. Could the market keep going? Of course, but what we want to do is take what is safe in quotes. Nothing is 100% safe, but this 50 retracement and the 161 extension seem to be a really accurate and really common ratio in trend trading that is worth exploring. You can see we are going back a little bit and moving into the pattern again. And at this point, you would be glad that you had taken the 161, not gambled with your profits. So again, bigger is not better in trading when it comes to targets. The wider your target, the less likely is it for the market to hit it. So go with something more moderate, 2 to 1, 2.5, 3 to 1. Try it in your back test and see how it goes. Don't go for those really extremely high reward to risk ratios. I've seen a lot of traders struggle with them, and they're very hard to trade mentally.